The next section, the last section really of the basic level, is the related studies section. Now, under related studies, I have A, trading bands based on daily close, moving average, convergence, divergence, Elliott wave, Gann, and candlesticks. Now, firstly, I incorporate Elliott wave, Gann, and candlesticks because a lot of people use Elliott wave. As I said earlier in the course, any technical indicator or any methodology worth its salt should help you to identify trend changes, support and resistance, and keep you focused on trend. Elliott wave, firstly, I do not personally use Elliott wave, but in years of meeting traders, seeing the ones that used Elliott wave being able, they talk about 5 waves up, 3 waves down, 5 waves up, but many times they will reach a point where they say, well, the preferred count, what we think will happen, is up. The alternate count would be that the market goes down. If an Elliottician is using RSI, taking the basic level and the checklist, and he thinks the preferred count is up and he sees a negative reversal, it puts more probability in the alternate count for the move down to be correct. And the inverse is true. If the market is down and the alternate count is up, and he sees a positive reversal show up, then he says the alternate count is probably the preferred count. Gann I include because what we had covered in time cycles I picked up from the Gann book about 1980, with breaking the year 52 weeks into the different time cycles, also using the price cycle analysis of taking the range and dividing it by 8 and dividing it by thirds to get the 1/3 retracement. I kid a lot of Gann traders about their angles. They're 1x2s, they're 1x4s, they're 1x6s, they're 1x8s, all these different angles going all over the place. When they ask me about, can't you see it hitting a line there? I said, it's hard not to hit a line. You've got lines all over the place. But I think the Gann has a book, and it's in the recommended section there, How to Make Profits in Commodities. If you will spend the $35, I think the philosophy of using weekly charts, which you hear most analysts talk about, trend analysis, the first 35 pages are worth the price of the book. The last one there, letter E, on candlesticks, I include candlesticks only because when I first started teaching the basic course, candlesticks were the latest craze coming out. I have not done a lot of work with them. I have looked at Steve Nissen's book. If you're interested in pursuing candlesticks or currently use them, you might want to get Steve Nissen's book on candlesticks. I think he's considered the authority on it. And of course, Elliott wave, just one further point on Elliott wave, Prechter's book. There are a lot of other books that other people are writing on Elliott wave, but I think if since Bob's been working with it as long as he has, and is considered by most to be the authority on it. But the candlesticks a lot of people are using now. It's a charting style from the Far East that has been around for a long, long time, and it's starting to gain a lot of credibility in the States. A lot of the patterns that you see in RSI will relate in one way or another to a candlestick pattern. If you have a software program, I know CompuTrack does, you can plot either a bar chart or the candlestick pattern, and it's quite interesting. Since I only look really at the RSI pattern and RSI chart first, if you put a candlestick chart study above it, and you have a book to refer back to, you might, if you're interested. I'm not saying you have to or you should, but it's just a different way. It's a different philosophy. Having the opportunity, like I've had over the years, to travel the world and meet people from different cultures and everything, it's interesting how we are all looking at the same thing. I'm talking in terms of technical analysis and study, but how we are all looking at the same thing through different windows or different views. And when different philosophies and methodologies line up, it should be a significant turn. So we're going to concentrate in this section just taking a look at some trading bands and using the moving average of the MACDs. The first chart there, 6-2, your upper chart, top chart, when you're setting envelopes or bands, again, the center of that band, you see in the upper left hand across the top, MA21. It's a simple 21 period moving average on close. Now the upper band is set 4% above the 21-day moving average. The lower band is set 4% below the 21-day moving average. And people say, well, you need a computer. No, if you can calculate the first 21 days to get your simple moving average on close, then carry that day forward and multiply it the next day by 20 and add in the new day, the 21st day, divide by 21, you'll have your new 21-day moving average. If you want to see what resistance is above it, take that value times 1.04. If you want to see what the support level should be below that, take that 21-day moving average times 0.96. So it's very easy to do with a calculator. Putting it on a chart, you're able to see it graphically, but being aware of where the upper band and lower band should be as far as support and resistance will give you further input as to what lies below where you are currently and what resistance levels are above it. The other thing, as is the case with any bar chart using a moving average, if the range and close are above the moving average, it's positive. If the range and close are below the moving average, it's a little more negative. Why I like to use them is when you look at an RSI chart, you can see different RSI patterns develop. And you see on, say, this upper chart, the top chart, if you look at the period, it looks like May of 1989, where we had some divergences that showed up in the RSI chart at the bottom, and then use your triangle, you see that the price action is pretty much, all of it is outside the upper band. But then you get another period later in the year where the RSI was trying to make another rally attempt and started to create a little divergence, and your 21-day band at the top was back inside. So at first it was outside and above the moving average, and also outside and above the upper band. But a little later, it was back inside the band, but the upper band was serving as resistance as the divergence was showing up. And the second part of divergence there, late in 1989, was below the 70 level, saying that the market was starting to lose a lot of momentum. This is also a weekly chart. It's not a daily chart, it's a weekly chart. So using a band, using a simple trading band, 21-day trading band, on a weekly chart will keep you, again, in that longer term perspective of whether you're too high or too low in conjunction with the RSI. The middle panel is an MA90, or a simple moving average 90. So it's got 90 days averaged in of closing prices. And in this case, the trading band is 6% above the moving average, and the lower band is 6% below. Pretty much when you're using these trading bands, The daily and weekly are going to be the most helpful. When you get into hourly and you're trying to do bands that are above, they're not really, to me, going to give you the type of input you would need or that would be the best for what you're doing. So you might have to shorten up the moving averages, but for trend analysis purposes, being able to see what a 21-week moving average looks like and where the trading bands are, or what a 90-week moving average looks like, to see the longer-term perspective, is very, very helpful for identifying major, intermediate, and major turning points. Just one or 2 points I want to point out on chart 6.2. If you look at the divergence that established in, looks like the March of 90, on your RSI chart at the bottom, would have been January, February, March in that first block. March of 90 versus May or June of 90, you started to get a little bit of a divergence. If you look at the bar charts with the moving averages on the 90, you were testing the bottom of the band, and in about June you were outside the band, but then turned and came back in. Same thing on your 21 day. If you look at where in 91 the RSI had pulled back to the 40 level, telling us the range on a weekly might have been now 80 and 40, or was at least finding support at 40. It went below the moving average 90, but it was close to the bottom of the MA21 trading band. It was close to the bottom of the band, saying it should be support. Well, your RSI 40 is saying it should be support. So if the RSI turns up from 40 and the 21-day band turns up from the bottom of the band and crosses above its moving average, remember I said the moving average, if it's above it, should be positive. We'll look at your RSI turning up, and then the moving averages on RSI, the 9 crosses above the 45. You see where the RSI starts to approach the 70 level, and prices are starting to approach the upper limit or the upper band on the 21 day, and also up near the upper band on the 90 day. You make a momentum peak above 70, and the RSI, when it's above 70, the price is breaking out at the top of the 90 band and up near the top of the 21-day band, saying it's indeed overextended. You get a pullback in price, comes down below the moving average and down to the lower band on your 21-day, back to the moving average on the 90, and back down near the 40 level. So it's something I think is very, very helpful for trend evaluation on a longer term basis. 6.3, just going to try and highlight a couple points for you. 6.3, if you look at a daily chart now on a November bean contract, this is one we had gone through where we put the RSI up, which is the chart at the bottom, where we had talked about that first divergence and then a second lower divergence. Look at your price action at the bands. The first divergence on your 21 period, you're outside the upper band. The second divergence that established the upper band on your 21 is serving as resistance. Your 90-day band, you never went outside the 90-day. And as the RSI started to sell off from that second divergence and the moving averages turned down, price action was going sideways above and below the 90, but price action on the 21 was pretty much staying under the moving average. And after moving averages had turned down on RSI, you had another attempt by the RSI to cross above the 45, which it couldn't do. You started to break below the 90-day moving average. You took out the support on the lower part of the band of the 21 and basically trailed and sold off all the way down from July into August, from early July into mid-August, it looks like, all below the 21-day moving average, all your price action was below it, and most of the price action in the bar was also below the lower band when your moving averages were going down on RSI, and you had also broken below the 40 level. So everything that we've gone through up to this point on pattern recognition, on signal counts, positive and negatives, bull and bear divergences, and top-bottom supports, whatever's on that checklist, if you put bands on your bar charts, see where those patterns are and see where the price action is on first the 21-day, which would be your shorter term look, and then on your 90-day. And when you get a little too oversold, like down in early August where the RSI had gotten down to 20, you were well outside the lower band on the 90, and you were outside the lower band again on the 21, and you started a little rally back up, and the moving averages started back up on RSI, and each rally back up, the attempt was to get back above the lower band on the 90 and regain that 21-day moving average on close to find support. But all the patterns that we've gone through, if you're able to identify a pattern and pull a chart up like this, you're able to see where it is in relation to a longer term perspective and where your support and resistance levels would be. Chart 6.4 showed what I was talking about when we went through the range, 4 signals, and the checklist. We started to make, in February, a low in momentum in RSI started to make higher bottoms, or a rising type bottom, to where even though prices were selling off to lower and lower lows, RSI was making higher bottoms. And then in April, it looked like you had a little 2 to 5 where maybe the price at point 2 was equal to the price where the X point was. But you were at the lower end of the band and a little bit outside the band on the 90, and you were starting to flatten out with the 21. You then cross back above the 21. The 90-day band prices moved back up inside the band. And look how the RSI moving averages had crossed back up and had that little pullback that we pointed out earlier, where it pulled right back to the 45 to find support, started to move up. Well, that pullback was just about as prices were trying to gain that 21-day moving average and stayed above that 21-day moving average. The 90-day crossed back above the 90-day moving average just about the time you start to see divergence form in the RSI, which says you should be in an uptrend. You're getting bearish divergence. Then you start to see indication of top bottoms and positive reversals kicking in. You break the divergence, you move up, and you break out of the top of the 90-day band, saying it's probably going to be an intermediate move to the upside. Your next one, 6.5, is where I put a bar chart with moving averages, an RSI chart with moving averages, and an MACD. Now the MACD is probably one of the more popular technical indicators available on almost every software program that I know of. And since it's more popular, I like to include it for the fact that it is good as far as, number one, in the center of that chart you'll see you have a 0 line. It incorporates using 2 moving averages and the formulas and everything you can look up. But basically it's a good trend monitoring system or trend following indicator. It will show divergences like it did in the lower left hand part of the chart that complement the RSI. It does have that 0 level to see whether or not you're above or below 0. It does show with the MACD standing for moving average convergence divergence, crossing below or above its signal line. But I'm not going to get in much on the MACD except for the fact that I include them because it is a very popular indicator. It's one that not only a lot of people follow, but follows RSI very well, to where if you saw in about the middle of the chart where the price had dipped down, RSI had dipped down, the moving averages had dipped down and crossed the downside, when the MAC turned back above its signal line, and then the moving averages on close turned up and the moving averages on RSI turned up, it had barely gotten below the zero line, and then retested it again later in time when the RSI was testing the 40 level, and you've got your moving averages on close still showing that it's positive, and then it crossed back above its signal line again and turned up. 6.6 or 6.5 is a weekly bond chart, and again, it's you can apply the MACD to the daily and hourly charts, but I like to use it in conjunction with the close moving averages and the RSI moving averages. 6.6 is a Swiss franc weekly chart. Weekly, showing you that perspective of the longer term again. But also you can see where the RSI made its low and the price made a low in the middle of the chart, with the moving averages on close down, moving averages on RSI down, and then the MACD started up across its signal line. We started up with the price and momentum in terms of RSI and the moving averages, and then made the higher bottom on the right hand side of the chart as the RSI was testing 40. You will also notice the left hand side as we started to make a little bearish divergence on the RSI, and the MACD crossed to the downside. $6.7 daily Swiss franc September contract. Here the thing to note was, look at where it crossed the zero line in May and turned up, as moving averages on RSI and close were turning up, and it went above zero. So we had talked about simple momentum before being above or below a zero line, and here is an MACD which is taking the two moving averages and the difference between those two smoothed by a third. $6.8, a dollar index chart. What I like the most, I guess, about the moving averages is for trend, and with the MACD being built around moving average and incorporating actually three of them, it's also a good trend evaluator. But it also has that zero line that you can be above or below. You will see divergences in MACD which will be helpful. You will see crossovers, I think, in it which would be helpful. But most of my work is primarily RSI and closes, but I will look at MACD and I will look at these trading bands as additional input, but my decision will be based primarily on what the RSI chart shows, also on what the trend analysis guidelines checklist for me shows, the basic 5-point, and then if I expand it to the other 10. But I like to incorporate other technical studies to build a complete model. But as I've always said, if anything ever happened to my computer, as long as I have that 5-point checklist on RSI and trend and be able to chart markets or graph them, recognize patterns, I feel very confident that I really will not run into major problems and will be in stay in tune with what's going on. Moving on to section 7, just a couple notes about the last few sections in the book and a few closing comments. We enclosed the glossary to help you with your note-taking, to help you with your study. I recommend you keep the book together, keep it close to where you're going to be doing your work so you can reference it and use it as a manual. But I do recommend, as I said before, with the checklist, that you write that checklist down and tape it to your computer monitor. You might want to also consider taking the glossary, making a copy of it, and laying that somewhere near your computer. So if you're doing your charts and you say, well, that looks like a negative, I can go back and quickly read the definition, which the more often you do this, the stronger you're going to be on developing a subconscious list. I had mentioned Mark Douglas's book, I believe, when we were talking about discipline, and I've talked to Mark on a number of occasions about how is it that sometimes we can look at a chart and we know. We just get a feel. He said, well, basically the feel comes from your subconscious taking over. You've incorporated everything to where you look at the chart. The more time, and I found this myself in talking to other traders and analysts, the more often than not, as you're doing your work, it will click. Just starts going off. We got to look at this chart, we got to go to this one, this, go down the checklist. But you don't even have to pull the checklist out. You see that 80-40, you see the guidelines for the moving averages, you see the positive reversals, the bear divergence, you know you want to buy, but you start saying, maybe it's not right yet because I hear everybody's talking about how much lower it's going to go, but you're going through this checklist in your minds, in your subconscious mind so quickly that you're saying, why? I haven't really done that much work, but I get this feel. That's where your gut feel, your subconscious is taking over. When you are sitting looking at a chart and it doesn't make sense or something's not right and you just feel that something's wrong, it's probably not set up properly and you're forcing the issue. You should get away from it and then come back to it. And that's why I said if you keep this glossary handy, as you see different patterns show up and you review it occasionally, it becomes part of your subconscious to where it becomes part of you. I used to say with weekend courses and basic classes, we'd have a bunch of robots going around reciting these rules and the guidelines, but when you leave here, you can look at any market you want and go through that checklist and figure out where it is, where's it going, where's support, where's resistance, what's my next move going to be, where's the last signal turn from. Section 8, I enclosed part of Wells's original chapter on the calculation of RSI and some of his explanation of some guidelines and how he built it. Just in case you want to review it, it also has the formula and all the calculation steps in there. I gave out the worksheets, the yellow worksheets, if you want to keep your own. So you'd be looking at 8.5, 8AA5, and 8AA6 to get your calculations for your different columns. Section 9, suggested reading for your bookshelf. I've mentioned some as we've gone along. I have each one of these books and refer back to them and keep them close by in case I need to refer back to them. It's a good base to build your library on because I think they're some of the best books out there. Number 10, recommended software, data services, chart services, other advisory services that I use, Bullish Consensus for sentiment numbers, Cycle Watch, Elliott Wave, just to see if they're saying, well, if this is up and this is the preferred count and this is the alternate count, and as I explained before, using Elliott. Gain angles. Phyllis and I have known each other for about 10 years, and when we agree on things, it's usually a strong signal, as would it be with Elliott wave, as would it be with bullish consensus. As I had mentioned, when a market is ready to turn on an intermediate to major basis, if you are looking at different methodologies, then they should be showing you basically the same thing. And then the last section, 10C, is a little bit on us and who we are. I think, just to make a few closing comments, I think at this point, while we do offer an intermediate and advanced course, I think what we went through here just in basic gets you started on the right road to where you can identify trend change, do price forecasting. I can't say, sometimes I don't know how to put into words how I feel about the RSI, but I have never seen anything like it. I have never seen an indicator that offered so much and was probably misused so often and underrated. And it can be an underrated indicator because I've seen analysts come in who never look at it, sit through the class, and Sunday afternoon it becomes their number one indicator. But it's something that if you put in the time and effort and study, you're going to be very much rewarded because of all the things you're going to be able to do, number one. All the sleep that you're going to have because you will not be worrying about markets and being on the wrong side of markets. And most of the surprises that you see take place in a market are generally going to be in the direction of the major trend, the intermediate major trend. So if you identify those intermediate major trends and position yourself properly, the surprises are going to be to the good for you. So I think if you put in the effort, you will get a lot out of it. We are also going to be moving more to money management and managing money and teaching fewer courses. So I think the way the markets are now, I think there is no difference. Somebody asked me in 1978 when I first started, this looks good and everything else, but do you think it's still going to work in 5 years from now, in 1983? I said, yes. They said, what if more and more people start getting a hold of it and start using it? I said, well, it doesn't matter because people tend not to follow discipline. I can teach you a methodology, I can teach you patterns and rules and guidelines, but I cannot teach you patience. I cannot teach you discipline. The two hardest things to learn to be successful in trading are patience and discipline. I wish I could teach you those things. But I can't, and all I can suggest is that you keep track of how you feel when you're trading. Are you tired? Are you excited? Are you scared? And start to learn a little bit about yourself, and this is one of the reasons I do strongly recommend Mark's book. But I think if you approach it as a business, I think if you are patient to wait for the signals and have the discipline to stay within yourself and within the parameters of your trading program, which I've given you as far as guidelines and checklists and patterns, and then I think you're going to be all right. But I think when you get high and mighty and you say, well, this time it's going to be different because I talked to this guy or that guy. But I think you'll be very happy with what you'll achieve, and I think you'll be very satisfied and realize that this is one hell of an indicator. So I want to thank you for your time, and if you put in the study and effort, believe me, you'll be rewarded.